พี่ทิพย์สุดานะครับเรียนท่านรองผู้จัดการตลาดหลักทรัพย์แห่งประเทศไทยพี่สันติกิรนันท์ครับเรียนท่านอดีตเลขาธิการสำนักงานกบข.นะครับและก็ที่ปรึกษาสภาธุรกิจตลาดทุนไทยทุกท่านครับรวมถึงแขกผู้เกียรติทุกท่านครับวันนี้เป็นงานสัมมนาย่อยของเฟดโก้นะครับสภาธุรกิจตลาดทุนไทยที่มีเมมเบอร์เป็นองค์กรหลักต่างๆในตลาดทุนทั้งหมดนะครับวันนี้เป็นงานสัมมนาย่อยครั้งแรกกับพาร์ทเนอร์ MSCI นะครับเราจะพูดกันถึงevolution of emerging market index นะครับแล้วอีกเรื่องหนึ่งที่ยังขาดไม่ได้แล้วก็เป็นที่สนใจปัจจุบันคือเรื่องของ ESG นะครับเป็นธีมของ investment ของ Asian ในปีนี้นะครับก่อนอื่นเพื่อไม่ให้เป็นการเสียเวลาผมอยากจะขอเรียนเชิญท่านประธานกรรมการสภาธุรกิจตลาดทุนไทยคุณวรวรรณธารภูมิกล่าวเปิดงานแล้วก็กล่าว opening speech ครับเรียนเชิญครับ
Good morning. On behalf of Federal of Thai Capital Market Organization, FEDCO, I welcome you, Mr. Chris Ryan, Managing Director and Head of Asia Pacific, and Ms. Emily Xu, Senior Research Associate, MSCI of Thai Capital Market. Welcome on board today, and welcome all of the team here. I'll be delighted to see you all here because this will be a great moment. And I think MSCI will have an exciting news after this, not only this topic about Thailand investment to show you today. Social responsible investing funds have been in existence for decades in the world. It is defined as an investment discipline that takes into consideration the environment or E, social or S, and corporate governance or G. So we call it ESG criteria to generating long-term competitive financial returns, in addition to positive impact to the society and local community as a whole. Sustainable investors do not aim for strong financial performance, but they also believe that this investment should be used to contribute to the advancement to the environmental, social, and governance practice as well. SRI, or Social Responsible Investment, will play an important role in integrating the sustainability of the corporate earnings along the line with growing of the society as a sustainable progression. Some of you might know that at BEBLAM, we have launched a fund like this. We'll be the pioneer of the market, but we might not be the best. I just hope that you all will follow this path and make a better fund for the ESG. And I have to thank you very much. We prepared this in 2 pages, and I think that it will have no fun if reading this. So just listen to and enjoy the world of the ESG. And I would like to give you some example. In the US, as much as $3.7 trillion and growing are invested in SRI strategy throughout the different assets class. A good case study in Thailand of the ESG that affect Thailand is the CalPERS. You know CalPERS, California Pension Fund. CalPERS is the largest U.S. public employees retirement fund. They withdrew over $1 billion US from emerging markets, including Thailand, which failed to meet social investment standards set by CalPERS. They reasoned that, quote, poor transparency of management, political stability issues, and poor labor practice standards were the key concern for withdrawing the fund on a 9-3 votes. This is an example. The world is going along this way. So if you don't start it today, you will be left behind. Thank you very much, and I hope you all will enjoy this seminar and learn valuable experience from MSCI team, which will be Kun Chris and Kun Emily will be the one who present this. Thank you very much, Kun Chris and Kun Emily in advance for your kind dedication today. ขอบคุณค่ะ
Thank you very much คุณวรวรรณครับพี่ตู่เตรียมกับผมว่ามีสปีชมาประมาณ3หน้าครับแต่ท่านพูดประมาณ5ประโยคผมเลยเตรียมตัวไม่ทันครับ Okay, next speech will be very interesting speech from Chris Ryan. Chris Ryan is managing director and head of Asia Pacific of MSCI, and obviously he has a very long time experience in financial market. He worked in financial market for 33 years, I believe, and has been a lot of head of a lot of institutional company in Asia and Europe. And he will deliver a speech for us today is that the future of Asia equity mandates, the changes of emerging market index and their impact on investment mandates. Ladies and gentlemen, please welcome Chris Ryan, please.
Thank you very much for attending this today, and I just want to say a word of congratulations to FEDCO because we work with a lot of associations around the region, but consistency and message are very, very important, and I think FEDCO, of all the associations that we work with, is very consistent and has driven obvious improvement in the industry here. I've been coming to Thailand for 25 years. Some of you I know in the room, there's a couple of people in the room who used to work for me, so hi guys. When I was at ING, investment management, we had the ING business here, and also at Fidelity, we worked with some of you here releasing offshore funds. So, you know, this market is fast developing, and I think despite the opinion of CalPERS, I think what you'll see today is why Asian equity mandates are going to change, and why Thai managers need to pay attention to this, because there are big opportunities coming. And I will describe where those opportunities are, and in the context, so companies like or funds like CalPERS. CalPERS, they issue investment mandates to managers who will either manage global or regional portfolios. Now, those global and regional portfolios are going to change. Now, they're not necessarily going to change because of Thailand, they're going to change because of countries like China. But it's important to understand the basics of why these things change and how Thai managers, Thai brokers, and everybody in financial services in Thailand can benefit from this. So let me start, if we can go to the next slide. So we'll start, as we always, every good story starts at the beginning, and we'll start at the beginning for the MSCI Emerging Markets Index. We will look at what are the current issues around emerging markets and what is the future for emerging markets. Now, apologies for the small text on here, but I think you have copies of this, so hopefully you can read it. The 25-year evolution of the MSCI Emerging Markets Index. If you go back to 1988 and you look at the largest component of the MSCI Emerging Markets Index, if I ask people in the US what was the largest component in 1988, if I ask people in Hong Kong what is the largest component in 1988, and surprisingly, if I ask people in Kuala Lumpur what was the largest component in 1988, nobody knows. But it was Malaysia. Malaysia was 30% of the index, almost 30% of the index in those days. Now, the changes since then do not reflect the performance of Malaysia. They reflect the entry of other markets, mostly entry of other markets and the growth of other markets. And if you look on the bottom chart there, before we go to the one on the top right, if you look at the bottom chart, what it shows you is that those changes to the markets, they often happen in stages. So when a new market like Korea, and I remember, unfortunately I can remember all of these events because I was there. 33 years is a long time. And thank you very much. Thank you. It's very good. But you've distracted me now. Thank you. But the point is that these things happen in stages, and they don't always happen smoothly when new markets come in. I want to just pick on a couple of examples here, and these are examples from my experience. So when India came in 1994, and at that time I had a group of fund managers managing Asian equity portfolios. MSCI put India in. Now, all the conditions at that time were satisfied by India to join the Emerging Markets Index. But the problem was, once the volume of money came into the Indian market, the operational system could not handle it. Why? Because India still operated with physical beneficiary certificates. So there were people literally running around Mumbai and Delhi with suitcases full of beneficiary certificates to be signed at the other end. That's what happened. Now, my fund managers came to me after 3 months and said, "Chris, this is crazy. We can't invest in India anymore." I said, "Why? It's in the index." They said, "Because we can't get the money in and we can't get the money out. And we can't trade our stocks, and so it's hurting our performance. We'd rather not be there." And so that's a learning experience both for MSCI and for the markets themselves, that all of the conditions need to be right. People think, well, why can't MSCI just put this market in or put that market in or what have you? But all of the conditions for operating a market need to be there, because if fund managers stop using that market for operational reasons, then that hurts the market, it hurts the credibility of the index, and it hurts the investor. Now, when you can also turn that argument around, and when we come back to Thailand a little bit later, there are things that Thailand has running in its favor with some of the frontier markets around it. And you can use your operational efficiency here in Thailand to your advantage. And so we will talk a little bit about that a bit more. Now, if you go fast forward to 2014, China is becoming a much bigger proportion of the overall emerging markets picture, but that is only basically H shares. So they're the foreign listed shares of Chinese companies. The S shares, P shares, red chips, and so on. And we'll cover a little bit more detail about that. But it is important that you understand this and that you watch what's happening, because once China comes in, a whole lot of changes are going to happen to these mandates. The existing mandates have the potential to break up into smaller components for Southeast Asia, for individual countries, and frontier markets will become more visible once this starts to break up. So overall, if we look at the growing importance of emerging markets, and for this one I have to put my glasses on, if you look at the growing importance of emerging markets in a global equity portfolio, you might say, well, that represents more money coming into global equities, and more money, being dedicated to emerging markets. Well, that's partly true, but what is also happening is just those economies in the emerging markets are growing faster. And the equity markets are growing faster as a result, because profits are there, because those companies are getting larger, so the emerging markets are representing a higher proportion of the global equity picture than they used to. There is something called if you think about news around the world today, you've probably heard of the CNN effect on news, right? There's a sensationalization of any small amount of news, events that probably 10 years ago would go unnoticed. Now, of course, they cover important things too, but they don't discriminate. So small events get as much publicity if it's a slow news day as large events. And unfortunately, that happens in the financial services news as well. So it's important to distinguish between what is important news and what is not important news. And when you look at emerging markets, often the press in the US or Europe or what have you will have some information about a company or about a scandal or about some kind of thing that's happening in Korea or China or in Indonesia or even in Thailand. But the point is, investors are starting to become more discriminating about that news. They are starting to understand. So when you see a big scandal or a big event happening and you don't see markets react, then people are starting to understand this CNN effect and how that can distort what's actually happening. They're looking, which is a good thing. So what will happen is, over the next few years, the emerging markets will be viewed much the same way as developed markets are from a fundamentals point of view. So the correlation, so this is a little bit about what I was just talking about. So the rolling correlation of emerging markets versus MSCI World has been increasing. Why? Because, as I mentioned, emerging markets is a bigger proportion of MSCI World. And also because the news is out there about emerging markets because of all the media, because of our friends at Bloomberg and Reuters and all these other places. There is more transparency about what's happening in these markets. And but the historical growth and the equity returns of emerging markets versus developed markets is still an extremely good picture. So despite what you might read in the media, emerging markets is still very clearly in focus for the investors around the world. And they're looking for different ways of accessing it compared to the past because of this correlation effect. So as correlation increases, they're looking for less correlated ways of accessing the emerging markets story. Okay? So the emerging market drivers are different. Now, country is the key factor in emerging market investing. It's very clear that that's the case. There's no single dominant key factor in developed market investing. So over time, emerging market investors are paying more and more attention to which countries they're going to overweight, which countries they're going to underweight. And they're looking at all the factors that are relevant to that market. So another compliment to FETCO and the SET and the other institutions here. Thailand has a big focus on SRI compared to many other markets. And it's very clear to us, and Emily will talk a little bit about this, that big improvements have been made here. I know that some of you think, wow, we have to do so much training and it's so regular and all the rest of it. But that's how you have to do it. And I think investors are starting to understand this. When I say to an American investor, which country in Southeast Asia has made the biggest improvement in terms of their ESG ratings? Which country? In the past, nobody has picked Thailand. Nobody. And when I tell them that it's Thailand, they're surprised. But when they look at the numbers, which Emily will talk to you about, it's very clear. So that is the right thing to do. You're certainly on the right track. You need to keep going from that point of view. And that will affect your country rating. So that's a good thing. Now, moving to the present. If we look at, now with these numbers, we're just about to update them for the end of December 14. But the historical performance, the premium discount, emerging markets have definitely outperformed developed markets over the long term. But the difference is volatile between developed markets and emerging markets. And that's to do with that correlation, as I said before. But if you look at individual countries, the picture is quite different. Now, I don't know whether we've got a chart on that. But if you look at the Global Investment Opportunity Set, so these are MSCI All Countries World Index. That's just representative of how global investors look at the global markets. It's all countries together. And if you look at the market cap weight, North America is 52.3%. But in terms of the revenue exposure of the companies within that index, so where do they get their top line from? It's only 30%. And, not surprisingly, emerging markets goes from 10% in market cap weight to 32%. 32% of revenues of global companies come from emerging markets. So it's the Unilevers and the Fords and the GMs and Toyota and all these companies that are, of course, present here in Thailand, but they're also present in, China and Africa and Latin America and Central America. They're present everywhere. And even, but Pacific doesn't change that much. But the big change is between emerging markets and, American companies doing business elsewhere. Right? So, looking at the future, I want to spend a little time focusing on China. Not everybody's sick of talking about China. I agree. I'm sick of talking about it. But it's very important from a dynamics point of view. Now, China is confusing. It's confusing even for, people in China. And we often mix up. I've been living in Hong Kong for 20 years, and I was lucky enough to start the first joint venture fund management company in China 15 years ago with China Merchants Securities. And yesterday I was talking with my old friend who is, she's now the head of one of the largest fund management companies in China. And we were talking about how all this is going to consolidate. And, even when we're talking, the two of us are talking, we mix up the terminology because there are actually 10 different ways to access China. I'm not going to go through them in detail, but you know about A shares. B shares you've probably forgotten about. Well, you should forget about it because they're going to disappear soon. So once the markets are open, there's no need for B shares. H shares, Hong Kong shares. Red chips, basically they're China-controlled companies listed in Hong Kong. P chips, and then listed overseas. So listed overseas is a growing category. I think everybody knows about Alibaba, right? Alibaba, familiar? Okay. Now, Alibaba, it's, by the way, its share price just dipped below $100 overnight. So the probably time to sell if you haven't, if you bought it at the, I don't know. But the point is that this is a very big company, but it chose to list in New York. And China is unusual in that its companies are listed not just in its own markets but around the world. And so when you're looking at China, the dynamics of China are not just the A-share market. They're not just Hong Kong. You need to take it all into account. Now, we don't have time to go through all the details today, but as an academic exercise, if you want to understand this, our team can spend as much time as you need going through and helping you understand this. And I'm coming to why that's important. So if you look at, this is the development of the China QFII, which is just the ability for foreigners to invest in China, and RQFI, which is the similar scheme but in renminbi and has other terms and conditions. And it looks at the growth of that over a period of time. So back in 2002, when we were, we'd only been for China Merchants Funds, which was the joint venture I mentioned before, there was no investment by foreigners in China. Today it's still not that large. It's only, roughly, actually it's gone from 400 billion to about, we're just about to update that again, 400 billion to about double that now, but still that's a relatively small amount of money compared to the size of the Chinese market. But just suffice to say that it's continuing to grow and it will continue to grow. So there's also the new Shanghai Hong Kong Connect program, and that again, we're not going to go through all of this, but that's yet another mechanism. This is option number 10, or alternative number 10 in terms of investing in China. You can go through the Hong Kong. You don't need to get any quota limit. You can invest through Hong Kong in certain stocks only listed in Shanghai at the moment, not in Shenzhen. So there's these multiple gateways to access domestic China A shares. Now, I want to just pause here for a minute and go back to the 1980s. And again, unfortunately, I can, because I can remember, being in the industry in those days. I remember headlines in the Wall Street Journal in about 1985 these headlines were worried that Japan was going to take over the global equity markets, because Japan was 50% of, roughly 50%, just under 50% of the market capitalization of global equity markets towards the end of the 80s. And of course, that's very much not the case now, but it's still a big market. But Japan's rise changed the way that people manage money. You can imagine if you're managing a global equity portfolio and you're not able to get Japan right, you're at a big disadvantage. But if you are able to get Japan right, then you have a big advantage. And times were different then, the portfolios were simpler, but if you look at those companies that had a big Japan presence at the time, they're still the companies that lead the global equity investment world. Those companies that did not have an operation in Japan, by and large, have struggled since that time. Because those performance dips, if you underperformed in Japan significantly, it's starting to fade a bit now, but up until the last few years, those performance dips have lasted for a very, very long time. If you underperform in Japan by 20%, it takes a long time in global equity portfolios to claw that back. And so China will be the same. Now, the good news about that is that some managers will say, we need to diversify into other mandate types. We need to, we can't compete with the big Chinese managers and those people who are already there. So we need to be looking for other things to do. What are the other things to do? Now, China will get to a point, maybe I think that's just, I think we already have addressed that. China will get to a point where it becomes, if all of Chinese market came in today, it would be, a bit more than 30%. So if the A-share market came in today, in fact, it would be, based on the recent valuations, it would be closer to 40% of the global emerging markets index, of which Thailand is a part. Now, when Japan was 40 to 50% of the global equity index, companies split that out from a management point of view, and they managed it separately. And they will start to do the same with China. China is too big, too diverse, too complicated for a portfolio manager that's trying to focus on 20 different markets to get China right. And to get global investment right, you've got to get China right, because it'll be so big once the A-share market comes in. We don't know when that's going to happen. It depends on further regulatory changes in China, and the timing of that is very uncertain. But the direction is set, and the government has been very clear that they want the Chinese market to open. As a result of that, you can see that the markets will, if investors start breaking China out, then there'll be a reweighting. It's not going to stop people investing in emerging markets indexes, but there's going to be a lot of volatility, and